Good afternoon, everyone. I'm Scott Andrews, and welcome to today's webinar where we're going to be analyzing historical price action and biases that have consistently occurred on options expiration day. First, the obligatory disclaimer. We're going to be conducting some detailed analysis and ask that you use this information at your own risk. Please keep in mind that quantitative research and backtesting is an imperfect science and that past performance may not be indicative of future results. That said, done properly with clean, well-scrubbed, and well-loved data like we use here at InvestorQuant, we believe that quantified edges can be fantastic building blocks for creating winning, rules-based strategies. Over the next 15 to 20 minutes, Matt, our Director of Training and Support and an integral member of our product management team, will do three things. He's going to analyze OPEX day via a wide range of different inputs from our various factor libraries. He's going to identify some of the most bearish and bullish scenarios for this unique day, and he's going to share a couple of his thoughts and considerations for tomorrow's OPEX day based on the current market environment. Please note that Matt will be using our next generation research and analytics platform, focusing primarily on the research part of it. There's an entire analytics section, which I'm not sure, I don't believe he's going to be showing. But at the end, I will wrap up and show you how you can learn more about it and how you can access it as a guest for a complimentary trial. In fact, if you submit, state at the end, you submit your request immediately after the webinar, we will be able to activate your trial and get you started within minutes. So lastly, we encourage your questions as always, and just please know that our focus is on completing this research and analysis on time. We're trying to keep this to about 30 minutes today so we can be cognizant and respectful of everyone's limited time as always. And we can follow up after the event if you have remaining or further questions. And without further ado, here's Matt.
Hey, Scott, thanks. So let me just get into this, get going right away. A couple research notes to be aware of. Everything I'm going to show here, I'm going to show with no slippage and commissions included. When I look at baseline stats, I prefer not to show slippage and commissions because they can kind of skew something out of, or they can skew a bias out just by the slippage and commissions. So I will not be including any of those here. They can all be added after the fact, and you can check them out on your own there. Testing period we're going to be looking at is starting back in 2003. We're going to be looking at some futures markets, probably going to focus mostly on the S&P 500 ES contract, and the trading hours that all of our data is based on is regular trading hours only. So that's 9:30 a.m. Eastern Time to 4:15 p.m. Eastern Time. That completes the session. So that's what our data is based on. That's what we're going to be looking at. So let's go ahead and get started on this. Let me take over the screen sharing here. And here we go. This is Discover. This is our platform that we use to do all of our testing. Today's focus is going to be on OPEX Friday. So the first thing that I want to do is I just want to look at some biases on every day going long at the open. So I've got the setup set to open, the trade type set to long, so that's entering at the open regular trading hours. I got three symbols selected here. We'll start with those and then narrow down. And I'm going to go into market events over here on the left-hand side. I'm going to scroll down on the events section until I find options expiration day. Here it is. Hit that equal sign or the minus sign next to it so I can look at all days that are not options expiration day. I'm going to click View Results here next, and this is going to give us the results of going long any day that is not OPEX Friday. So this is kind of what we'll want to be comparing to. This is a good baseline just to look at here to see what we're working with. And you can see the equity curves here generally sloping upwards to the right. Stats, nothing really overly impressive here. 44% win rates across all of these. Average trades, not all that impressive. Profit factors, not. But this is our baseline. Generally sloping to the upside if you're buying the open and selling the close of regular trading hours. So now what I want to do is I want to go in here and look at what happens on any day that is OPEX Friday. So I'm going to go back to market events. I'm going to scroll down and I've got it excluded here. So I'm going to just click on the equal sign next to it. And this is going to isolate options expiration day to see the differences between OPEX day and non-OPEX day. So here we go, and quite drastically different. So this is going long at the open of OPEX Friday, closing at the end of the session. You can see doing that historically has been a pretty consistent losing bias if you're going long. So this is good information. This tells us that the short side has been favored on the longs or at the open to close of regular trading hours on OPEX Friday. So this is what we're going to work with. We're going to work off of this key information here that going long at the open on OPEX day has not been favorable. So from here, I'm going to go back up to symbols and settings. I'm going to focus in just on the ES since that's what most people trade, and it'll be a little less confusing than seeing a bunch of things at once. I'm going to flip this to a short. So setup's going to stay intraday open. I'm going to go to the short side here for trade type. Run it again just so you can see what going short at the open of OPEX has done historically. View results. And as soon as I click it, it should show up. There we go. So these are the results of going short at the open on OPEX Friday. This equity curve looks much better than what we saw and looks quite a bit stronger than the overall bias as well when you think of going long all days compared to going short on OPEX Friday. So this is a good bias that we can work with, and we can drill down into this a little bit more here in the short time that we have together. So what I want to do next here is, now that we've seen that there is a short bias showing up in the data, I'm going to look at a couple different setups to take advantage of this short bias. The first one I'm going to look at beyond just getting short the open. So I'm going to go 60-minute range. And this is just looking at the first hour's range and looking at the highs and lows of that range and then trading around the highs and lows of that range. So since we know that the bias is to the downside, we saw that from the opening stats, I'm going to look at just the short trade types on the 60-minute ranges. So I'm going to start with the high fade. This is getting short one tick in front of the high made in the first 60 minutes of trading on OPEX Friday. I'm going to keep my stop and target set to end of day. So it'll be the same that we saw with the opening information, and run it. So this is getting short, 60-minute high, holding for the close. And that bias looks fairly similar. It's holding up pretty well here. If you're waiting till later in the day, waiting for 60 minutes into the session for that high to be retested and shorting. So this is good information as well. This number is holding up strong. Now let's look at going short on a low breakout of the 60-minute range. So this is getting short at one tick below the lowest low made in the first 60 minutes on OPEX day. Click view results here. And now we're starting to see that the bias is not nearly as strong. So our key takeaways so far: getting short on the open on OPEX has been strong. Getting short a 60-minute high fade has been strong. But the low breakout, getting short down there, has not been all that consistent. It's had some nice wins here recently, but overall, that bias is not too strong. And then lastly, I want to look at one other setup before we isolate some additional information for these. And I'm going to look at getting short the last hour of OPEX Friday. So this is getting short at 3 p.m. Eastern Time and exiting at 4:15 p.m. Eastern Time. And this one as well, kind of similar to the low breakout, not consistent. It's been very strong recently, but there is no long-term bias that's showing up. All this strength has basically come in the past year and a half or so. So this bias not nearly as strong long-term as what we saw getting short at the open and getting short on the 60-minute high fade. So I'm going to go back to the open. It had the best stats, the most samples to look at. And we're going to go back to getting short. I'm going to click over here on exit, reset it back to end of day stop, end of day target. And then I'm going to come down to price patterns. price patterns will let us look at adding a little bit of context of what has happened the prior day. So that's what's happening right now as we speak, basically. And I'm going to look at, let's just look at two things here. I'm going to look at where are we closing relative to the opening price for the day before. So are we closing above or closing below the open? So I'm going to start with closing above the open. I'm going to hit the equal sign next to it here for location last close. Close above the open. Once I do that, you see it shows up here at the top with the market event as well. And then I'm going to hit view results. And this will look at getting short at the open on OPEX when the prior day closed above its open. Now this does not look so great to me. This really hasn't worked in 8 or 9 years. Looks like it was making equity highs somewhere around 2010. But since then, if the prior day has closed above the open, it really has not worked. That bias has not been strong. So this is something to remember as something that you may want to avoid if you're looking for the short bias on OPEX day. So now let's go back the price patterns and let's look at closing below the open. Going to hit the equal sign next to that. And then I'm going to hit view results again. And here we go. These are all the days where the day before options expiration closed less than the opening price for that day. And this one looks much more consistent. Long-term bias here showing up for 16 years or so, consistently being favored. Win rate's just north of 50%, but what I really like about this is you get these average wins to average loss ratios really strong. That's 1.5 plus, so that's pretty good when you've got a win rate of 50-ish%. So that's something to consider, something to remember. Let's look at one more here while we're in price patterns, and let's just look at closing in the top half of the range versus closing in the bottom half of the range. So I hit equal sign here next to close in top half of daily range. I'm going to hit view results again. So this is just looking at where did we close in relation to the midpoint of the regular trading hours session. And this is showing closing in the top half. This looks similar to that closing above the open, so kind of confirming that idea of a little bit of strength in the regular trading hours of session has not translated well the next day for the bearish bias. This is pretty flat here going back to around 2011 or so. Let's do one more here and let's look at closing in the bottom half of the daily range. And this one fairly consistent again. This one doesn't look quite as strong to me as closing below the open, but it's a similar shape and equity curve, and the stats are pretty similar. So I like that. And those two little tests there, the key takeaway from those is a little bit of weakness the day before OPEX has helped the short bias on OPEX Friday. So keep that in mind. Next, I want to look at some indicators here. And I'm going to look at a volatility-based indicator, the average true range, and I'm going to look at isolating when the one-day average true range is greater than the 5-day average true range. So it's just kind of a short-term volatility measurement compared to a slightly longer short-term volatility measurement. So quick view results here. This looks great. Very nice profit factor there. The average win to average loss closing in on 2.0. That's very good when you've got win rates, 50% or anywhere reasonably close to that. That's very strong. This is a strong filter. This is something you're going to want to remember. 1-day ATR greater than the 5-day ATR clearly helps the short bias on OPEX day. Let's take a look at when it's not, when the 1-day ATR has compressed. or is smaller than the 5-day ATR, and look at it again. Here we go. This is not showing a consistent edge. Looking back over the past 5+ years, it's been quite weak. So this is a potential risk factor for going short on OPEX. Certainly has not worked anytime recently. Long-term stats really not that good either. Had a nice run up through 2012 or so, but has not done well recently. So this is hurting the bias on the short side, and that's something that you would want to keep in mind. All right, next, let's look at bullish and bearish markets. Now, there's a lot of ways to define that. We've got a bunch of different ways here, but I'm going to focus on something that you guys are probably all familiar with, and I'm going to look at a 50-day simple moving average just being greater than the 200-day simple moving average. So every charting platform that has charts should have this available to you. This is nothing complicated. But it's one way to define a bull market. So when you add that, and what we're doing here is we're looking at OPEX Friday when the 50-day moving average is greater than the 200-day moving average. It's going short at the open and closing at 4:15 p.m. Eastern Time. This bias is staying pretty steady to the upside. So even in this bullish market condition, the bias is still there. That's something you want to remember. When you find something really strong, it can overcome the longer term bullish nature of the market, and this one's doing that. So now let's go back and look at when the 50-day moving average is less than the 200-day moving average. So just down here at the bottom of the box, there's a little equal sign. I'm going to click on that. Once I do, you can see it added back up here to the header section. And I'm going to hit view results. This will be looking at this more bearish market condition. This equity curve here looks a little weird. And the reason why it looks weird, you see like these really long flat periods. And that's just because the market was not meeting these conditions during that time. So there's just long periods of time where nothing happened. None of the conditions were met. So I imagine the 50-day moving average was not below the 200-day moving average very much during that period. That was super bullish market back then. But takeaway from this, again, equity curve still moving higher, lower left to upper right. Win rate's just a touch smaller, but when it's winning big. Winners almost 2 times the size of the losses on average. So bullish markets, bearish markets, this is still holding up on the bias to the short side on OPEX day. So that's a good piece of information there. All right, next, I'm actually going to go back up a few steps here, and I'm going to look at some opening filters because we've seen a bunch of things that are all pointing towards the short bias being pretty good. Let's see if we can learn a little bit more by adding where we're opening at on OPEX. So I'm going to look at 3 different opening zones, and this is just opening above the prior day high, opening in range, and opening below the prior day low. So come tomorrow, we'll be looking at what today's high is for this level to see if we're opening above or below it to meet that criteria. So once I click open above prior day high, view results, this will give us the results of going short on OPEX day when opening above the prior day high. This one's, again, fairly consistent, a little bit flat here recently, but overall bias is still favoring the short side even when opening above the prior day high, which can often be a bullish sign. This has favored the short side here historically with a little bit of choppiness here recently. So not seeing a major avoid sign there, which is really what I'm looking for at this point. Let's look at opening within the prior day's range. So all you got to know is what was yesterday's high, what was yesterday's low. Are we opening somewhere in between there? And that's what this is looking at. So this looks good long-term. A lot of samples in there. A little bit of flat period happening here, but it's recovered and it's starting to make new equity highs again. Long-term stats look pretty good. Decent win rate, decent average win, average loss. Bias is holding up well there. So I would not want to avoid that and probably want to hone in on that a little bit more. That looks pretty strong. Lastly here, I want to look at opening below the prior day's low. So a gap down below the prior day low on OPEX day and shorting. And this one does not look good. So this is good information. This tells you, something that you'll want to avoid. Getting short down below prior day's low on the open has not worked historically well on options expiration day. So that's something I would not want to be shorting on OPEX day if opening below the prior day low. All right, so now, after we just looked at some different opening areas, we've seen opening above prior day highs pretty good. It was a little flat recently, and opening in prior day's range was the best of the three. So what I want to do is I want to take this idea, opening in prior day's range, just look at it one more time here. This is what we're working with as the baseline for opening in prior day's range and getting short. And I want to add one of the filters that we looked at here on an individual basis. And I just want to go back to that ATR filter that had a good amount of samples and was quite consistent. And that one was the 1-day ATR is greater than the 5-day ATR. So I'm going to click on the equals there and add it. And this will show us the combination of the two. Now, of course, when you combine things, you do start to lose sample sizes, but it does isolate the more favorable conditions. And that's what we're seeing here. When the 1-day ATR is greater than the 5-day ATR, and we're opening within the prior day's range on options expiration day, it's resulted in some pretty nice moves to the downside and pretty consistently as well. So your average win quite a bit larger than your average loss, and your win rate greater than 50-50, getting close to 60%. That's a pretty strong and pretty consistent bias. And one thing I want to do here is just put a loose stop on it. This can be honed in on a lot more, but if you put a loose stop on it, 60% of the 5-day ATR, and still run it again just to make sure that it's holding up, it does. So the stats don't change much. Equity curve may have actually got a little bit smoother, but that idea is holding up with a stop. And now one more thing is I just want to look at this and add the NASDAQ to it. NASDAQ gets a lot more volume than the others, so I'm going to compare it with the NASDAQ and see how these do. And the same filters applied to the NASDAQ gives us, make us click on this box here, which will change the stats below. And I can hover over NASDAQ here to highlight the equity curve. The equity curve certainly been a little bit stronger recently, but the stats all look very strong here as well. Pretty strong bias. In fact, if you even wanted to add some slippage and commissions to this to see how that would impact it, you could come up here, symbols and settings, just type in, what, 20 bucks, usually what I look at. Hit view results again. And this is what it's done historically with a $20 slippage and commission applied to it. So that looks pretty good. In fact, I'm just going to save this real quick. If you scroll down at the bottom, you can save your strategies. So I'm going to call this OPEX OIR for open in range short, and hit save strategy. Once I do that, we've got strategy sections here where it'll save all the strategies that you create, and you'll actually get alerted on them when they're in play for the next day. Okay, we're supposed to be done at 12:30, and I am 4 minutes from 12:30. So I'm going to stop here. Hopefully you guys learned something interesting that maybe you can use. Maybe hopefully applicable for tomorrow. But I do need to stop here because we promised you it would be 30 minutes and we're getting close to that. Yes, this will be recorded. Let me go ahead and hand it back to Scott and let him try to wrap this thing up and get you guys out of here. And then we can try to answer any questions, however we need to do that as well. So
Thank you, Matt.
all right, there you go, Scott. Go ahead. Thank you.
All right, so we should be seeing the slides. Everyone should be seeing a slides. Go to the next slide here. I just want to share a couple ideas. I thought Matt did a great job. Appreciate you powering through that. Matt, there are a couple questions coming through. You can try to address some of them. Any ones that we, by text, any ones that we don't get to, you can certainly reach out to us independently as well. But I want to share some ideas as well. You can test different stops and targets. We really didn't do that here, but you can do that within the platform, and that does change the parameters because unless you're trading options, you don't really have a way of knowing what kind of risk you're taking with futures. We do not suggest you use end-of-day stops and end-of-day exits in that regard. You want to have some type of a controlled risk parameter. We use volatility-based. You can do dollar point-based within the platform as well. As Matt showed you briefly, there are other entry times and techniques that can change the results. Some are better, some are worse. Definitely check some of the other equity indices, though they are correlated. We've looked at all of them. Probably the most interesting thing I stumbled on myself, we were doing a little research earlier this week, was some of the relationships with, like, say, 10-year notes. That's not a big surprise, right? Interest rate notes. Crude oil, silver, some very interesting correlations or counter correlations. And not only were average trades significantly impacted, but win rates as well, which tells me there might be something there. Reasons, I'm not quite sure, so you want to be cautious anytime you trade anything or consider trading anything without really having a clear hypothesis on why the relationship might exist, because you want to be careful not to be trading noise, right? You can, if you test enough things within a back testing type of environment, you can stumble on some random noise. So you want to be careful, always have some type of hypothesis. Couple calendar considerations I noticed uh, that you might want to test before Martin Luther King weekend and President's Day. So in the first quarter there, some of these short biases are not nearly as strong. In fact, a bit of a long bias actually exists. So that's another consideration that'll be coming up in this coming quarter. And there's some really interesting correlations as well on the day before and day after options expiration day, which we simply don't have time to show you today. But I do encourage you to do further testing. If you are a programmer or have the ability to do programming or have resources, definitely consider these other ideas. If you don't, then I welcome you to try trial of our third generation platform. So we've added the research component, made that public, I should say, for the first time recently. And you can do so with the following link right here, investaquant.com/discover. You can learn a little bit more there and request a free trial. If you do so in the next 30 minutes or so, I've got David and our guys in the back prepared to send out your login information. And I'd like to wrap it up, if I may, with just sort of a final closing thought. Some of you know us. This is a pretty friendly list. In fact, we've only invited folks that have been not even all of our folks on our mail list, but some of our folks on our mail list. This is the first time we've done a webinar like this, so I do welcome your feedback. But if you don't know us well, I'd like to sort of explain what we're doing and what the whole idea behind Discover is. We've been around for more than a decade, which a lot of people don't realize, but it's actually been over a decade. We started in 2008 during the financial crisis. It was quite a time to start educating and helping traders, and we did quite well. In fact, a lot of folks did well following along with some of our signals and some of our research back then, and some of those guys are still with us today, believe it or not, actively subscribing and using our tools. And I'm very proud of that. And I think it speaks to the quality of the work we do or always aspire to do. But since that time, we've evolved our company's focus to be really exclusively focused on what we believe is the single biggest need in this industry. And that is for a robust, institutional grade quantitative platform and service that can be used at a fraction of the cost of alternative approaches, and that not only can, but does measurably improve many traders' performance. We have a very ambitious, that's a mouthful, an earful, very ambitious goal, but we have created a platform that's part research and part real-time analytics. We have not shown you any of the real-time analytics today, but our clients have used our tools for a long time, and they tell us that we help them. And many of these clients, by the way, are existing commodity trading advisors, professional money managers, managing people's assets, as well as former professional traders, members of prop shops, hedge funds, and so on. And they tell us that we've helped them in several very important and different ways. And in fact, I believe these are the three keys to success for all traders: identification of quantified opportunities and risk. In fact, many traders have told me that simply by helping them avoid trading against quantified historical biases, they've been able to improve their win rates and performance considerably. So I ask you and challenge you to think if that would help you as well. And if so, then we might be able to help you with the platform. Secondly, traders tell us that we help with their conviction. By providing robust, quantified historical data, we provide insight and the needed confidence to help press one's bets or lay off, back off, reduce your position size. And that can make a quantified impact on your performance. And thirdly, especially with this new research component that's on our platform now, we help you diversify. Clients tell us that we help them expand their strategies into other markets, and we help them find new opportunities to trade existing and new markets as well. So with all that said, I appreciate you being here, appreciate your interest, your questions, and we invite you to join us. Let us help you, help us help you, I should say. And thank you, everyone. Trade smarter.